Knowing exactly when to buy a stock before its share price ascends to new highs can be extremely profitable. The internet is filled with all sorts of technical buy indicators that may help you achieve this feat. But technical indicators are primarily used for trading strategies, and they don't necessarily carry over well to a more conventional buy and hold strategy, much less a dividend-focused strategy. So what should dividend growth investors do? The answer is, of course, look for a fundamental buy indicator. Much like technical analysis, there is no perfect fundamental strategy that will help you hit home runs with all of your buys. But perhaps that is not where we should focus our attention. What if, instead of trying to hit home runs, we try to turn a few of our singles into doubles or triples? Consider this: the stock market has on average grown at a rate of about 10% per year. Sure, there's been better and worse decades where this average didn't quite hold true. But let's just assume, if you invest for long enough, you'll come close to this long-term average rate of return. What if we find a fundamental buy indicator that can boost our return by, say, 25%? That may sound like a lot, but it's actually not. It's the difference of earning a return of 12.5% instead of 10% per year. At a 10% annual return, the value of our money doubles every 7.2 years. But at a 12.5% annual return, the value of our money doubles every 5.7 years. This 1.5-year difference may not sound life-changing, but extrapolated over a longer horizon, it can compound fairly quickly. After a decade, the 12.5% annual return will lead to a 25% higher value relative to a 10% annual return. After 2 decades, the margin of difference will be more than 50%, and after 3 decades, it'll lead to nearly twice as much value. So a mere 2.5% extra return per year can double your money during a typical 30-year investing journey. This all sounds nice, but how do we actually hit more doubles than singles with our investment decisions? Well, let me tell you about the free cash flow yield buy indicator. Free cash flow is considered one of the most important measures of a company's performance. It is also used in one of the most popular valuation methods, the discounted cash flow model. The free cash flow yield, on the other hand, is a financial solvency ratio that tells us how much free cash flow a given company is generating relative to the price of its stock. When the free cash flow yield increases, the stock is more attractively valued, and when it decreases, it is less attractively valued. And to come up with a fair valuation, we can track the long-term average free cash flow yield to give us a steady baseline. Let's take a look at Visa and its long-term free cash flow yield. In the bottom right chart on the screen, we can see Visa's free cash flow yield, the blue line, juxtaposed with its 5-year rolling average, the red line, for the period May 2017 through May of 2024. We can see that the free cash flow yield oscillated between 2 and 5% during these 7 years. Meanwhile, the 5-year rolling average free cash flow yield oscillated between a much narrower range, approximately 3.3% to 3.8%. Using some simple math, we can convert this yield chart into a valuation chart, shown in the top right. This is a much easier visual that can help indicate more opportune times to invest in the stock. Before we jump into the analysis, let me explain exactly what you're looking at in this chart. The black line is the price history for Visa's stock between May of 2017 and May of 2024. The 3 shaded green areas at the bottom of the chart represent different valuation zones. The top of the lightest green shaded area is the baseline fair value price. The top of the green shaded area represents a 10% margin of safety applied to the baseline fair value price. And the darkest green shaded area is a 20% margin of safety. You can see that Visa's share price moved within and above these valuation zones during the last 7 years. Based on the free cash flow yield buy indicator, whenever the share price is within one of the green zones, it suggests that the stock is either fairly or attractively valued, and it's a good time to buy more. The light green zone would indicate the stock is reasonably valued. The middle green zone would indicate the stock is attractively valued, and the dark green zone would suggest that the stock is very attractively valued. Since we have all of the data for this time period, the actual share price, and the suggested fair valuations for each trading day, we can analyze how using this buy indicator would have turned out. To normalize the data, I annualized all of the returns based on the number of trading days through May 20th, 2024. These are price-only returns, excluding any dividends, which would just be icing on the cake here. And I also removed the last 12 months from the analysis to give me true annual returns. So the period that was analyzed was May 22nd, 2017 through May 19th, 2023. This included 1,509 trading days during which we could have initiated a position in Visa stock. The average annualized return for all 1,509 days was 12.97%, which is pretty good for a price-only return. If you tack on the 0.75% dividend yield that Visa typically offers, you're looking at an annual return of 13.7%, simply from buying Visa every day. Reinvesting dividends would compound this return a bit more and probably push it over 14% per year. But what if we only invested in the stock on the days during which Visa's share price was trading above its trailing free cash flow yield? These would be the days where the price was below the light green line in the valuation chart. Out of the 1,509 trading days analyzed, the share price fell into this zone on 718 instances, roughly 47.5% of the time. The average return of investing in Visa stock on all 718 of these days was 16.35%, which is a nearly 26% improvement over the 12.97% average return for all of the trading days. If we apply the same strategy, but this time use the 10% margin of safety valuation instead, the results improve slightly, with the average return now jumping up to 18.28%. However, this does significantly reduce the number of days where the stock is rated as a buy, from 718 days to 393 days, or about 26% of the days in the full dataset. Using the 20% margin of safety valuation zone, we can further improve the average return to 19.12%. But this drastically cuts down the number of days where the stock is rated as buy, from 393 days down to just 134 days, or about 9% of the days in the full dataset. So, on average, we can say that using the free cash flow yield as a buy indicator for Visa stock would have led to improved returns during the last 7 years. The additional benefit of using this indicator would have been that it helps in limiting you from buying the stock when it was grossly overvalued. If we take a look at this table of the analyzed data, we can see the worst and best possible single-day return of investing in the different valuation zones covered previously, and the 791 days where this model suggested Visa was not attractively valued. The worst possible price-only return for Visa during this 7-year time frame would have been a mere 3.76%. Using the fair value zone, the worst possible return we could have ended up with was 9.36%, considerably better. And the worst possible return for the 10 and 20% margin of safety zones would have led to further improvements. 12.98% for the 10% margin of safety zone, and 13.46% for the 20% margin of safety zone. What's interesting is that using the 10 or 20% margin of safety, in this example, it would have been impossible for us to achieve worse results than investing in Visa every single day, since the worst daily return for the 10% margin of safety zone is 1 basis point above the average return for the full dataset. This same buy indicator would have also worked well for Home Depot, Applied Materials, and MSCI, but it doesn't work well for all stocks. It works best for great companies that have a long and steady track record of free cash flow growth. And it also requires that these companies continue growing their free cash flow in the future. So the burden is first to find these companies, and then apply valuation techniques like this one to improve the timing of your buys. I am on a quest now to build an investable universe of stocks that fits this criteria of being a great business, and to run them through this free cash flow yield valuation test to see if it can add value. Perhaps I'll share the full list at some point in the future. If you'd like to review this information again, you can do so in my newsletter that is linked in the description below. I covered the same topic in the latest episode. The return data will differ slightly, as the newsletter was written on a different day than this video, and the analysis in this tool changes every day with the stock market. I hope you enjoyed the video. If you did, please return the favor and give this video a like and subscribe to the channel. Thank you for watching and see you next time.